You've been staring at charts, but you haven't been seeing them. You've been lied to by every indicator, every guru, every can't-miss pattern. They sold you a system, but they only gave you confusion. Why? Because they never taught you to listen to the one thing that actually matters, the market's real voice. Welcome to Trading Psychology Stick, the channel where we decode the market's mind, not just its movements. Think back, March 23rd, 2020, COVID panic. The S&P 500 crashes to 2237, blood everywhere. Except, market profile traders saw something different. Massive rejection below, buyers flooding in, the auction screaming, "This is temporary." 3 months later, new all-time highs. While everyone else was trading the news, they were reading the structure. And now, for the obligatory disclaimer, I'm the auctioneer showing you how the room works. I'm not the one placing the bids for you. Your capital is your paddle. Use it wisely. This is educational art, not a one-way ticket to a Lambo. So, if you're ready to finally see the invisible structure behind the chaos, let's begin. Section 2, the $40 million auction lesson, Christie's Auction House, New York, November to 2021. A Basquiat painting hits the block. The auctioneer starts at 40 million, silence. He drops to 35, still nothing. 30 million, a paddle rises. 32, another bidder. 35, 38, 40, 45, 50, sold for 51.3 million. What just happened? The auction didn't predict the price. It discovered it. Through process, through negotiation, through making the invisible visible. And your market, it works exactly the same way. Every second, the market runs an auction. Buyers bid, sellers offer. When buyers want it more, price rises. When sellers press, price falls. But movement isn't the story. Where price pauses is. How long it stays matters more than how far it goes. Volume at a level speaks louder than the breakout above it. October 13th, 2022. CPI data hits. Market gaps down 2.4%. Disaster, right? But watch what happened next. No continuation, no panic selling, time accumulated at the lows, volume dried up. The auction said overreaction. By close, green. The profile readers knew by 10 a.m. Everyone else, still shorting the news at noon. Because here's what they don't understand. Every candle is just punctuation in a larger sentence. A bullish candle doesn't mean bullish market. It means buyers paid up for that moment. But did they stay? Did volume confirm? Did time accept the new price? Most traders see the what. Profile traders see the why. In market profile, this process becomes visible. Like X-ray vision for price action, you see where value forms, where buyers failed, where sellers absorbed, where real business got done versus where price just visited. You stop reacting to every tick, start responding to actual structure. Price is like a tourist. It visits many places. But where does it live? Where does it set up shop, build relationships? That's value. And value, not price, tells the real story. The auction never lies. It can't. Because it's not predicting, it's revealing. Every rotation, every extension, every rejection is the market discovering truth in real time. Your job isn't to outsmart it, it's to interpret it. Quick test. Last trade you took. Did you enter because price moved or because the auction structure suggested opportunity? If you can't answer that, you're still trading blind. But that changes now, because next, you'll learn the 3 forces that drive every auction. Master these, and the market becomes readable. Section 3, time, price, volume, the trillion-dollar Trinity. Price screams, volume shouts. But time whispers, and whispers tell the deepest truths. January 6th, 2021. Tesla hits 880, headlines everywhere, euphoria. But here's what most missed. Price touched 880 for exactly 3 minutes. 3 out of 390 minutes that day. The auction visited, looked around, and left. Fast. That's rejection, not acceptance. 2 weeks later, Tesla at 780, a 100-point drop that time already predicted. Because price lies. Constantly. It shows you where the market went, not where it wanted to stay. Like judging a party by who walked through the door, ignoring who actually stayed to dance. Time shows you where the market feels comfortable, where it builds relationships, where it calls home. Now add volume, the market's energy signature. High volume means argument, disagreement, battle. When high volume meets extended time, you've found conviction. The market didn't just visit, it moved in, set up furniture, invited friends. These areas become what we call value, not just numbers, psychological fortresses. Picture this: two price levels. Level A gets hit with a massive volume spike, then price races away. Level B sees moderate volume, but price rotates there for 2 hours. Which matters more? Level B, every time, because time plus volume equals memory, and markets like elephants never forget. In Market Profile, this trinity becomes visual through TPO charts, time price opportunity. Each letter represents 30 minutes of market activity. Stack them up, patterns emerge, distributions form. The market's true structure reveals itself, not through lagging indicators, through actual market generation. September 13th in 2022, FOMC Day, market touches 4,005 separate times. Each touch, more time, more volume, more letters stacking. The TPO chart showed a massive concentration, a magnetic point. When price finally broke away, it snapped back within hours, because 4,000 wasn't just a number. It was home. Most traders chart price over time. Profile traders chart acceptance over time. Massive difference. One shows movement, the other shows meaning. One tracks the tourist, the other maps where they live. Want proof? Pull up any chart. Find the biggest move last week. Now check how much time was spent at the top. Usually, almost none. The market sprinted there and left. Now find where price spent the most time. That level will act as a magnet for days, sometimes weeks, because time creates gravity in markets. Drop a comment with the price level where your favorite market spent the most time today. Tomorrow, watch how price respects that level. You'll see the magic of time-based memory in action. The formula is simple. Price tells you where. Time tells you importance. Volume tells you conviction. Together, they show you where the market actually lives versus where it just visits. But seeing these areas is only half the battle. Next, you need to understand what shapes them, how the market builds its home, the blueprint hiding in plain sight. Look at any chart right now. See chaos? Or do you see a shape forming? Squint a little. Step back. There, behind the noise, a curve, a distribution, a blueprint the market leaves behind without realizing. That's the profile, and it tells you everything. August 24th of 2015. Flash crash. Dow drops 1,000 points in minutes. Chaos, right? Except the profile that day formed a perfect B shape. Long tail below, fat acceptance above. Translation? The crash was rejected, violently. Those who could read the shape bought the bottom. Everyone else? Still panicking at the close. Market Profile doesn't predict, it reveals. Like a detective at a crime scene, it shows you where the market spent time, where it ran, where it accepted its fate. The shape tells the story, and there are only a few stories the market knows how to tell. At the heart sits the point of control, the price with the most time, the king of the day, where negotiations centered, where bulls and bears found temporary peace. Around it spreads the value area, usually 70% of the day's activity, the market's living room, its comfort zone. But comfort isn't profitable. Discomfort is. And that's where the magic happens. Because when price lives in comfort too long, energy builds, pressure mounts, then explosion. The profile shows you this. Not through prediction, through structure. Sometimes the profile forms a perfect bell curve, balance, agreement, the market thinking, not moving, like a compressed spring storing energy. Other times it stretches, elongates, forms what we call trend distributions. One-sided affairs where buyers or sellers dominated. No negotiation, just capitulation. Then there are the broken ones, split profiles, B shapes, P shapes. These tell tales of failure, of rejection, of trends that started and died. Each shape whispers different intelligence. Once you learn their language, you can't unsee their message. October 19th, 1987. Black Monday. Dow drops 22%. Largest single-day decline ever. But look at the profile. Massive P shape. All the time accumulated at the lows. Sellers exhausted. Buyers stepping in. The shape screamed bottom while the world screamed disaster. Those who could read profiles made fortunes. Others just made headlines. Every day the market writes its autobiography. In shapes, in distributions, in time-based acceptance and rejection. Your job isn't to predict tomorrow's story. It's to read today's chapter, understand what was written, then position yourself for what comes next. Because the market moves in patterns, not price patterns, behavioral patterns, psychological patterns, and the profile captures them all, like a seismograph for sentiment, a photograph of the invisible negotiation happening beneath the surface. Type yes if you're starting to see the shapes behind your charts, because once you see them, everything changes. The market stops being random, starts being readable, but shapes only tell you what is. To trade them, you need to understand the two states the market lives in, balance and imbalance, the calm and the storm. And knowing which one you're in, that's the difference between profit and pain. Section 5, Balance versus Imbalance, the $2 million distinction. The market has two moods, only two. Master this, and you'll never be confused again. May 6, 2010, the flash crash. In 36 minutes, the market dropped 9%, then recovered almost entirely. Traders who understood balance versus imbalance made millions. Those who didn't, they're still in therapy. Balance is the market at rest, thinking. Rotating, probing. Neither buyers nor sellers in control. Price oscillates in a range. Volume distributes evenly. The profile forms a bell curve. Beautiful, symmetric, deadly if you don't recognize it. Because balance isn't boring, it's preparation, like a coiled snake, motionless but ready. Most traders see the lack of movement in force trades. They short the high, buy the low, over and over, getting chopped up, bleeding slowly, not realizing the market isn't moving because it's thinking. And when you trade a thinking market like it's trending, you lose. Then comes imbalance, the strike. One side overwhelms, price runs, doesn't look back. Single prints form, tails appear. The profile stretches like pulled taffy. This is the market in motion, not thinking, acting, and if you're still trying to fade the move because it went too far, you're fighting a tsunami with a bucket. February 5th, 2018, fourth and first implosion. Imbalance all day, tight range, low volume, then 4 p.m. hits. News breaks, volatility explodes. In 15 minutes, 50 drops 96%, from balance to imbalance in seconds. Profile traders saw the coiling, the compression, the energy building. When it released, they were ready. Everyone else, destroyed. Here's the secret. Markets don't randomly switch between these states. They signal. Balance areas get tighter. Rotations fail. Volume dries up, like a heartbeat before the attack. The profile shows this, not through indicators, through structure itself. December 26, 2018, the day after Christmas. Market gaps up huge, but look closer. No continuation, no follow-through. Price immediately starts rotating, building value below the open. That's not imbalance. That's a failed auction. By noon, the entire gap filled. Traders who recognized the fake imbalance profited. Others bought the top and prayed. The rule is simple. In balance, trade the edges, sell resistance, buy support, take profits quickly. In imbalance, trade the direction, buy breaks, sell breakdowns, hold for continuation. But mix them up, use balance tactics in imbalance. That's how accounts die. Watch any market for a week through this lens. Note when it's balanced, when it's imbalanced, when it transitions. You'll start seeing the rhythm, the breathing pattern, the market's natural cycle between thinking and moving, rest and action, consolidation and trend. Because every explosive move starts from balance. Every balance forms after imbalance exhausts. It's a dance, a rhythm. And once you feel it, you stop fighting the market. Start flowing with it. Stop predicting what should happen. Start recognizing what is happening. Comment if you've ever faded a trend that wouldn't stop, or bought a breakout that immediately reversed. That's the pain of misreading the market's mood. But now you know, balance or imbalance. The only question that matters, get it right? Profits flow, get it wrong? Pain follows. But how do you catch the transition? How do you spot the moment balance becomes imbalance? That's where the opening tells you everything. If you know how to read it. Section 6, the first 30 minutes, where fortunes are made or lost. 4 a.m., futures open. By 9:30 a.m., the market has already decided what kind of day it wants to have. Most traders miss this completely. They wait for the market to settle. They miss the announcement. Because the open doesn't just start the day, it reveals the day. March 9th, 2020. Limit down. Market opens down 7%. Trading halted. Disaster? Look at the profile. Open drive down. No rotation, no acceptance below. Single prints everywhere. This wasn't a balanced open. It was pure imbalance. Initiative sellers in complete control. If you tried to buy that dip, you caught a falling knife. The open told you, don't fight, follow. There are only a few types of opens. Learn them, and you'll never be surprised again. Drive open, fast, directional, no looking back. Price races away from yesterday's value. This screams imbalance, conviction. Don't fade it, ride it, or wait for exhaustion. But never step in front. That's like arguing with a stampede. Test open. Price probes yesterday's edge, touches, reverses. That's responsive behavior. The market checking if yesterday's opinion still holds usually leads to rotation, balance, range-bound action, perfect for fading extremes. Rejection open, price attempts new territory, gets smacked down, hard, fast, with volume. That's not just resistance, that's disgust. The auction tried and failed. These often lead to opposite direction trends, because when one side fails that hard, the other side takes control. Open auction, most common, price rotates in a range, building the initial balance, no clear direction, the market waking up, stretching, deciding. These can break either way. Your job? Wait, watch. Let the market tip its hand. June 11th, 2020, Fed Day. Market opens perfectly balanced, rotating in 20 points, low volume, no conviction, classic open auction. Then 2 p.m., Fed speaks, explosion, 100-point rip in minutes. But here's the key. The morning's balance predicted afternoon volatility. Compression leads to expansion, always. The open isn't random, it's logical. Overnight inventory meets day session liquidity. Traders who held overnight meet fresh money. That collision creates patterns, readable, tradable patterns. But only if you're watching. And it's not just about type, it's about context. A drive open after 3 days of balance? Significant. A test open after a trend day? Normal. Context amplifies meaning. The open plus, where we've been equals where we're going. Try this tomorrow, first 30 minutes. No trades. Just classify the open. Drive, test, rejection, auction, write it down. Then watch how the day unfolds. The correlation will shock you. Because the market tells you its intentions early. Most just aren't listening. The real edge? Combining open type with overnight activity. Did overnight accept new value, or just probe and fail? Compression leads to expansion, always. Is the day session confirming or denying overnight's work? These questions turn observation into opportunity. Type the last open type you remember trading. Did you align with it or fight it? Your answer reveals why you won or lost. Because trading the wrong open type is like dancing salsa to a waltz. The music doesn't match your moves. But once you hear the rhythm, once you identify the song, everything flows. And if the open is the first verse, the day type is the full song. Each day has a personality, a character, a way it wants to behave. Learn the 5 types, and you'll never be caught off guard again. Section 7. The 5 market personalities, and how to profit from each. Every day the market wakes up different, like humans. Some days it's focused, driven, trending hard. Other days it's confused, choppy, indecisive. If you treat every day the same, you'll lose, because the market has personalities, 5 of them, and each demands different tactics. Normal day, the unicorn, happens maybe 5% of the time. Price opens middle, tests both sides equally, closes middle, perfect bell curve, beautiful, balanced, boring. Most traders force action on these days. Bad idea. The market is being fair, diplomatic. Your job? Small trades, quick profits, don't overstay. Trend day, the gift. Price opens and marches, one direction, minimal pullbacks, single prints trailing behind like breadcrumbs. These days pay for your month. If you recognize them early, the key, don't fight, don't fade, don't get cute. Just follow. Add on pullbacks. Hold until close. Let winners run. August 5, 2011. S&P downgrade, Dow drops 634 points, textbook trend day, open drive down, no bounce over 20 points all day, single prints everywhere. Traders who recognized the personality made fortunes. Those who bought dips, destroyed. The market wasn't negotiating, it was liquidating. Neutral day, the trap. Looks like a trend day at first. Price breaks the initial balance. Everyone chases, then reversal. Hard, fast. Breaks the other side, traps everyone. These days punish the impatient, reward the observant. The tell? Watch the first break. If it lacks conviction, lacks volume, lacks continuation, prepare for reversal. Normal variation day. The tease. Like normal day, but picks a side eventually, spends more time, more volume on one end. Subtle, easy to miss. The market showing slight preference. These days reward patience. Let the market reveal its hand, then position accordingly. Non-trend day. The grind, narrow range, low volume. Price hugs the open all day, maybe 0.5% range. These days test your discipline, because boredom leads to bad trades. Forced entries, revenge trading. The market is sleeping. Let it. Come back tomorrow, December 23rd, 2019. Day before Christmas. 10-point range all day. Volume at 30% of average. Classic non-trend day. Smart traders took the day off. Others lost money trying to create action where none existed. Sometimes the best trade is no trade. Each personality leaves clues early, usually within the first hour. Trend days show immediate imbalance. Normal days establish early balance. Neutral days flash false breaks. The profile captures these clues, makes them visible, tradable. But here's what matters most. Your strategy must adapt to personality. Trend following on a normal day, death by 1,000 cuts. Mean reversion on a trend day, one cut but deep. The personality determines the playbook. Use the wrong one, lose every time. The market isn't trying to trick you. It's telling you exactly what kind of day it wants to have, through structure, through behavior, through the profile's shape. Your job isn't to impose your will. It's to recognize the personality and adapt. Write down the last day type you traded. Did your strategy match the personality? If not, that's why you struggled. Because fighting the market's personality is like swimming upstream. Possible, but exhausting, and usually pointless. Flow with the personality instead. Let the market's mood guide your method. But remember, the profile isn't a crystal ball. It's not a system. It's something far more powerful. It's a lens. And like any lens, it only works if you look through it correctly. Section 8. Profile isn't the answer. It's the right question. Most traders collect systems like baseball cards, moving averages, Fibonacci, Elliott wave, profile. They plug them in, wait for signals, lose money, then blame the system. But here's the truth. Profile isn't a system, never was. It's a lens, a way of seeing. And that difference, that's everything. Systems give answers. Profile asks questions. Where is value? Who's in control? What structure is forming? It doesn't tell you, buy here, sell there. It shows you market structure and says, what do you see? If you need someone to tell you what to trade, you're not ready for profile. Because profile demands thought, interpretation, context. It's like reading versus being read to. One builds intelligence, the other builds dependence. Most traders want dependence. They want daddy indicator to tell them what to do. Profile doesn't play that game. October 15th, 2014. Treasury flash crash. Yields drop 37 basis points in minutes. Unprecedented. Most systems crashed, signals failed. But profile traders? They saw single prints, rejection tails. No acceptance at the lows. The structure screamed false move. No indicator needed, just eyes, context, understanding. Think about it. An indicator takes price, runs it through a formula, spits out a number. It's processed, delayed, interpreted, but profile, it shows you raw market behavior, where traders actually did business, not where a formula thinks they should have. It's the difference between reading a restaurant review and eating the food. RSI says overbought. So what? Maybe it stays overbought for weeks. Moving average says trend up. But is it initiative or responsive? Profile shows you where time was spent, where volume traded, where acceptance lives. Facts, not opinions. Structure, not signals. This frustrates traders. They want profile to tell them exactly what to do, when to buy, where to stop, how much to risk. But that's like asking a telescope to take the picture for you. The telescope just helps you see. You still need to know where to look, what to look for, how to interpret what you find. And that's the power. Once you stop looking for signals and start reading structure, everything changes. You see the market's grammar, its syntax, its rhythm. You stop asking, what's the setup, and start asking, what's the context? Better questions lead to better trades. January 29th, 2021, GameStop Mania. Price goes from 100 to 400 in days. Every indicator screaming overbought. Sell signals everywhere. But the profile? Showing acceptance at every level. Building value higher. No rejection. The structure said, continue. The indicators said, stop. Who was right? Profile doesn't compete with your indicators. It provides context for them. That break out your system signals, profile tells you if it's happening at poor structure or solid value. That support level everyone's watching, profile shows if there's actual acceptance there or just a quick touch. It's not about profile versus everything else. It's about profile with everything else. Context plus confirmation. Structure plus signal. Understanding plus execution. The lens that makes everything else clearer. Drop a comment. What system are you using now? Whatever it is, add profile context to it for 1 week. Watch how your win rate changes. Not because profile gave you signals, because it helped you see which signals to take and which to ignore. But to use this lens properly, you need peripheral vision. You need to see not just today's profile, but how profiles stack over time. Because context isn't just about now, it's about the narrative, the chapters, the story being written across days, weeks, months. Section 9, Stacking Time Frames. The trillion-dollar perspective. A single profile is like a single word, meaningful but limited. Stack profiles together, now you have sentences, paragraphs, stories. And stories? That's where the real money hides. March 2009, financial crisis bottom. Daily profiles looked chaotic, violent, scary. But stack them into weekly composites, different picture, higher lows, value migrating up, acceptance building. The weekly story said accumulation, while the daily story screamed panic. Those who could read both perspectives bought generational lows. This is the art of composite profiles, merging time, stacking context, seeing the forest and the trees simultaneously. It's how institutions think, how smart money operates. And if you're only watching one time frame, you're playing checkers while they play chess. Start with the daily. It's your immediate truth. Today's negotiation, the current conversation. Where did value form? What type of day was it? Where did the auction fail or succeed? This is your tactical view, your execution time frame. But don't stop there. Zoom out to 3 days. Now you see development. Is value trending, overlapping, expanding? This tells you whether the market is discovering new prices or accepting old ones. If daily values stack vertically, momentum lives. If they overlap horizontally, balance builds. Simple, powerful, ignored by 90% of traders. Zoom out to weekly, monthly. Now you see structure, major balance areas, long-term distributions, where real support and resistance live. Not lines on a chart, actual high-volume nodes where business was done, where pain was felt, where memory exists. This is your strategic view, your bias builder. November 8th, 2016, election night, futures limit down, daily profile, chaos, but weekly composite, sitting right at major support, monthly, bullish trend intact. The micro screamed sell, the macro whispered buy. By morning, limit up. Context saved those who could see it. Here's the magic formula. Monthly tells you environment, weekly tells you bias, daily tells you entry. When all three align, that's when you size up. That's when conviction peaks. That's when the market speaks clearest. But when they conflict, that's information too. Daily breaking above weekly balance, potential new trend, weekly rejecting monthly resistance, probably fake breakout. The conflicts tell you when to be careful, when to wait, when the story isn't clear. Think of it like weather. Daily is today's forecast. Weekly is the front moving through. Monthly is the season. You don't wear shorts in winter because today is warm. You don't short a bull market because today is red. Context prevents stupid trades. August 24th, 2015. flash crash mentioned earlier. Daily, disaster. Weekly, tagged major support and reversed. Monthly, bull market pullback. Those trading daily got slaughtered. Those who stacked time frames bought the gift. Same day, same move, different perspective, different outcome. The skill isn't just seeing multiple time frames, it's weighing them correctly. In strong trends, daily matters most. In balance areas, weekly dominates. At major inflections, monthly rules. The time frame hierarchy shifts with market conditions. Static rules fail, dynamic thinking wins. Try this. Before your next trade, check 3 time frames. What's the daily story? Weekly narrative? Monthly structure? If they agree, trade big. If they conflict, trade small or not at all. This one habit will transform your results. Because context isn't optional, it's essential. Stack your time frames, read the full story, trade the complete picture, not fragments. And once you see the full picture, once you understand the narrative, you can stop reacting to what happens. Start preparing for what might happen. Because professionals don't predict, they prepare. And preparation beats prediction every time. Section 10. Preparation is the professional's secret weapon. 6 p.m. Market closed. Amateurs shut down their screens. Go watch TV. Check tomorrow. Professionals? They're just getting started. Because the real work happens when the market's closed. Preparation. The invisible edge that separates winners from losers. Here's what nobody tells you. Professional traders spend 3 hours preparing for every hour they trade. They map scenarios, plan responses, identify levels. By the time the bell rings, they're not thinking. They're executing a plan. While others react, they respond. Massive difference. Start with structure. Where's the current balance area? What's the recent trend? Are we coiling or trending? This is your foundation, your market GPS. Without it, you're driving blind. Every trade starts here, context first, always. Next, overnight. The market trades 23 hours now. Overnight isn't noise, it's information. Did Asia accept US value? Did Europe extend it? Is overnight building new value or just exploring? Volume heavy or light? This tells you institutional positioning. What smart money did while retail slept. Now, build scenarios, not predictions. Scenarios. If we open above value and hold, then what? If we test overnight low and reject, then what? If we gap up and fail, then what? Write them down, all of them. Because one will happen, and when it does, you're not surprised. You're prepared. December 13th, 2018, Fed Day. Every professional had the same scenarios. Open in balance, expect rotation until 2 p.m., open above, watch for failure, open below, watch for short covering. When market opened 20 points higher and immediately failed, they were ready. Preparation, the invisible edge that separates winners from losers. Shorts loaded, stops clear, target identified. Retail, still figuring out what happened. The magic happens when scenario meets reality. Market opens. You watch, not for setups, for scenario confirmation. Which story is unfolding? Once identified, execution becomes mechanical. No emotion, no hesitation, just implementation of a prepared plan. But preparation goes deeper. Mark your levels, not random lines, structure-based levels. Where's the POC? Value area edges, poor structure zones, single print areas? These aren't just numbers. They're magnets, battle lines, decision points. Mark them all. Then add time. When does Europe close? When do bonds settle? When does crude pit close? Markets move at specific times for specific reasons. Know them, use them. While others wonder why price just spiked, you're checking your clock. Europe close. Normal. January 3rd, 2018, first trading day of year. Professionals prepared for one thing. New money, pension funds, 400 1K allocations, January effect. When market exploded higher on massive volume, they weren't surprised. They were positioned. Preparation paid. Ignorance cost. The ultimate preparation? Mental. What's your goal today? Trend day expecting 50 points? Take it. Normal day with 10-point rotations? Scalp it. Non-trend day? Skip it. Match your strategy to market personality. Before the open, not during. Because here's the truth. Trading isn't about being right. It's about being ready. Ready for your scenario to unfold. Ready to admit when it doesn't. Ready to execute when it does. Ready to wait when unclear. Readiness beats prediction. Every time, tonight, prepare tomorrow. Build 3 scenarios. Mark 5 levels. Identify 2 time frames. Write it all down. Then tomorrow, just execute. Watch how different it feels. How clear. How calm. Because when you're prepared, the market can't surprise you. It can only confirm or deny what you already considered. But even the best preparation can't prevent the market's favorite trick, the failed auction, the fake out, the trap. These aren't random, they're structural. And if you can spot them, they become your biggest opportunities. Section 11, Failed Auctions, where millionaires are minted. Every breakout starts with promise. Price pushes through resistance. Volume spikes. Twitter explodes. To the moon. Then, nothing. Price stalls, reverses, collapses, trapped longs, panic, shorts pile in. And those who recognize the failed auction, they're counting profits. Failed auctions are the market's gift to the observant. They occur when price tries to discover new value but gets rejected, violently. It's not just a reversal, it's a broken promise, a narrative that died. And dying narratives create the best trades. May 6, 2010, flash crash. Before the main event, ES pushed above 1170. New highs, bullish, right? But look closer. No volume, no time, single prints below. When price collapsed back through 1170, game over. The failed auction triggered the cascade. Those who recognized it were short before the panic. Everyone else, deer in headlights. How do you spot them? 3 clues. First, poor structure at the extreme. Single prints, low volume, no rotation. Second, quick rejection. Price doesn't linger. It runs away, like touching a hot stove. Third, acceptance back in the prior range. The market saying, never mind, we belong here. The psychology is beautiful. Breakout traders get trapped. They must exit, creating pressure, momentum, urgency. You're not trading a pattern. You're trading trapped traders' pain. Their forced liquidation becomes your entry, their stop loss, your profit target. But timing matters. Don't fade the first push. Let the auction fail first. Let rejection show itself. When price re-enters the prior range with conviction, that's your signal, not before. Patience pays, anticipation kills. February 11th, 2016, crude oil. After months of decline, price pushes above 30. Finally, bulls rejoice. But profile shows no acceptance. Single prints. Poor high. When price collapsed back below 30, next stop, 26. A 15% move triggered by recognition of failed auction. One pattern, massive profit. Context amplifies power. Failed auction at the edge of weekly balance, strong. At monthly extremes, stronger. At yearly highs or lows, strongest. The bigger the time frame, the bigger the failure, the bigger the opportunity. Stack your context, size accordingly. The best part? Failed auctions happen daily. Every market, every time frame. Once you train your eyes, you see them everywhere. That spike that couldn't hold. That breakdown that reversed. That gap that filled. All failed auctions. All opportunities. But beware false failures. Sometimes price retests the extreme, builds acceptance, then continues. The difference? Time and volume. Real failures reject fast. Stay away. False failures consolidate. Build value. Then extend. Read the nuance. Master the difference. June 23, 2016. Brexit vote. Futures collapse overnight. Down 5%. End of the world. But cash open shows massive responsive buying. Time accumulating. Volume exploding. The overnight auction failed. By lunch, green. By close, up 2%. 7% swing for those who recognize the failure. Failed auctions teach humility. The market doesn't care about your analysis, your targets, your opinions. It cares about acceptance. And when acceptance fails, price must return to where it's accepted. Physics, not prediction. Market law, not market theory. Type failed if you've ever been trapped in a false breakout, because now you know why, and more importantly, How to be on the other side next time. The side that profits from recognition, not pain from participation. But failed auctions are just one actor in the market's drama. To truly understand price movement, you must know all the characters. The initiative players who create trends, the responsive players who fade them. The battle between these forces writes every price chart. Master this dynamic, and you master the market. Section 12. Initiative versus responsive. The eternal market war. Two forces fight every tick. Initiative traders push price to new territory. Responsive traders pull it back. This battle, invisible to most, drives every move you see. Understand who's winning, and you'll never be confused by price again. Initiative activity is aggression. Traders believing price is wrong, pushing it somewhere new. They break balance, create trends, leave single prints. They're not reacting, they're acting. When initiative controls, markets move, fast, far, with conviction. October 13th, 2023, CPI surprise, initiative sellers hit immediately. No hesitation, no rotation, just selling. Price drops 60 points in 30 minutes, single prints everywhere. That's initiative control. You don't fade that. You follow or you wait, but you never fight. Responsive activity is defense. Traders believing price went too far, bringing it back. They create rotation, build balance, fade extremes. They're the market's rubber band. When responsive controls, markets chop, rotate, mean revert. See the difference? Initiative creates, responsive corrects. Initiative trends, responsive ranges. One pushes, one pulls. And the profile shows you exactly who's in charge, through structure, through behavior, through time. In the profile, initiative leaves fingerprints, single prints, elongated distributions, value migration, price spending little time, moving fast. When you see these, trend mode, trade accordingly, don't fight, don't fade, follow. Responsive leaves different marks, rotation, bell curves, overlapping value, price revisiting levels, building time. When you see these, range mode, fade extremes, sell resistance, buy support, but quickly. Because responsive control means choppy action. The $1 million skill, recognizing the transition. When responsive becomes initiative, when balance becomes trend. Because that transition, that's where fortunes are made, or lost if you're on the wrong side. August 24th, 2020, tech correction, started responsive, normal rotation, selling at highs, buying at lows, then something shifted, selling intensified, rotation failed, initiative took control. In 2 days, NASDAQ dropped 10%. Those who recognized the shift profited. Those who kept buying the dip, destroyed. But here's the nuance. Both forces always exist. It's about dominance. Strong trends still have responsive players. They just lose. Strong ranges still have initiative players. They just fail. The profile shows you who's winning, not who's playing. And context matters. Initiative at the edge of monthly balance probably fails. Responsive in the middle of a weekly trend probably loses. Stack your time frames, weigh the forces, trade the probability, not the hope. December 14th, 2023. Fed pivot, responsive sellers all morning, fading the gap, selling rallies, then Fed speaks. Initiative buyers explode, responsive sellers crushed. 80 points in 45 minutes. The force shifted, the profile showed it. Single prints, no rotation. Pure initiative. The practical application? Simple. Identify the force. Trade with it. Initiative up. Buy dips. Initiative down. Sell rips. Responsive control. Fade extremes. But always with stops. Because when control shifts, it shifts hard. Watch your next session through this lens. Every move, ask yourself, initiative or responsive? Who's pushing? Who's pulling? Who's winning? This question alone will transform your trading, because you'll stop trading price. Start trading forces. Type initiative or responsive based on what controlled your market today. Then look at your trades. Were you aligned with the controlling force or fighting it? Your answer explains your results. Because trading against the controlling force is like swimming upstream, possible, but exhausting, and usually unprofitable. The final shift isn't technical, it's mental. Stop thinking like a predictor. Start thinking like an auctioneer. Because that mindset change, that's where mastery lives. Section 13. Think like an auctioneer, not a gambler. You've spent years learning to trade, studying charts, perfecting strategies, chasing profits. But what if everything you learned was backwards? What if the key isn't thinking like a trader, but thinking like an auctioneer? An auctioneer doesn't predict, doesn't hope, doesn't force. An auctioneer facilitates, discovers, reveals. They start high, gauge interest, adjust, find balance. Exactly what markets do, every second, every tick, every day. The mental shift changes everything. Traders ask, where will price go? Auctioneers ask, where is price accepted? Traders predict future. Auctioneers read present. Traders impose opinion. Auctioneers interpret reality. One creates stress. One creates clarity. Think about it. At an auction, does the auctioneer get angry when bidding stalls? Do they force higher prices? Do they predict the final bid? No, they read the room, adjust to reality, facilitate discovery. No ego, no opinion, just process. March 2020, COVID crash. Traders panicked, predicted depression, fought the bounce. But auctioneers? They watched acceptance build at 2,200, saw rejection of lower prices, recognized value migrating higher, no prediction needed, just observation. Those who thought like auctioneers bought the low. Traders, still fighting reality at 3,000. The auctioneer's edge is emotional detachment. Price isn't personal, movement isn't meaningful, only acceptance matters. This lens removes fear, eliminates hope, destroys greed. You stop caring where price should go. Start caring where it's accepted. Every profile tells an auction story, where bidding was aggressive, where it dried up, where sellers overwhelmed, where buyers absorbed, not through prediction, through observation. The auctioneer sees what is, not what should be. This mindset shift kills the need to be right. Auctioneers aren't right or wrong. They're accurate or adjusting. Big difference. When price reverses, traders feel failure. Auctioneers see new information. One breeds revenge trading. One breeds better decisions. October 1987, Black Monday. Traders fought the crash, bought every dip, got destroyed. But those thinking like auctioneers, they saw no acceptance at higher prices, continuous rejection, sellers overwhelming buyers. They didn't predict the crash. They recognized it unfolding, then traded accordingly. The practical shift starts with language. Stop saying, I think price will. Start saying price is showing. Stop predicting. Start observing. Stop imposing. Start interpreting. This isn't semantics. It's rewiring your brain, your approach, your results. Because auctioneers have one goal: find fair value. That's it. Not make money, not be right. Not beat the market. Just discover where buyers and sellers agree. When you adopt this goal, trading becomes clear, simple, profitable. The market doesn't hide its intentions. It broadcasts them through time, through volume, through structure. But you must think like an auctioneer to see them, to interpret them, to profit from them. Tonight, watch any market, but differently. Don't predict, don't analyze. Just observe like an auctioneer. Where's the interest? Where's the rejection? Where's the acceptance? This lens alone will show you more truth than 1,000 indicators. Type auctioneer if you're ready to stop fighting the market and start facilitating its discovery. Because this shift from trader to auctioneer, from predictor to interpreter, that's where mastery lives. But even auctioneers must recognize weak foundations. Poor structure in markets, like poor construction in buildings, eventually collapses. And knowing where these weak points hide, that's pure gold. Some market moves are built on granite, others on sand. The difference? Structure. And poor structure, like a house with no foundation, always collapses. Always. The only question is when. And if you can spot it, you'll profit from it. Poor structure happens when markets move without conviction. Fast price, low volume, no time, like building a skyscraper in a day. Looks impressive, won't last. The profile shows these areas clearly. Single prints, gaps, spikes, all screaming unsustainable. January 26, 2018. Stock market melt-up. SPX rockets 150 points in 10 days. Straight up. No pause, no rotation, single prints everywhere. Poor structure defined. 2 weeks later, collapse. Market drops 12%. The poor structure didn't predict the crash. It identified where collapse was probable. Think of structure like construction. Good structure has layers, time at each level, volume confirming, rotation building, like bricks with mortar, strong, sustainable. Poor structure, price without time, movement without volume, height without foundation, unstable, temporary. The market remembers poor structure, always returns to repair it. That gap from 3 weeks ago, market will fill it. Those single prints from yesterday, price will revisit. That spike with no volume will get retested. It's not prediction, it's probability, based on structure, not hope. This creates opportunity. Mark every area of poor structure. Gaps, single prints, spikes, low volume extensions. These become targets, magnets, destinations. When price eventually returns, and it will, you're ready. Positioned, profitable. But patience is required. Poor structure can extend further before repair. Days, weeks, sometimes months. The market isn't on your schedule, but when repair begins, it's often violent, fast, complete. Because poor structure creates vacuums, and markets like nature abhor vacuums. February 5th, 2020, Tesla rockets to 969, parabolic, single prints from 700 to 900, classic poor structure. 2 weeks later, it's Tesla at 650, a 33% collapse. Not because Tesla was bad, because structure was poor. Those who recognized it shorted the top, or bought the bottom. Both profited. The nuance matters. Not all gaps fill. Not all single prints repair. Context determines probability. Poor structure in a strong trend might extend further. Poor structure at range extremes probably repairs soon. Stack your time frames. Read the context. Trade the odds. Watch how institutions handle poor structure. They don't chase it. Don't trust it. They wait for repair, for acceptance, for real structure to build. Then they act, with size, with conviction. Because good structure supports weight, poor structure doesn't. October 2022, bear market rally. SPX jumps 200 points in 3 days. Poor structure everywhere. Retail chases. Institutions wait. 1 week later, back to lows. The structure told the story. Those who could read it avoided the trap, or profited from it. Poor structure is opportunity delayed, not denied. Mark it, track it, wait for it. When repair comes, be ready. Because the market always pays those who recognize structure, and punishes those who ignore it. Always. Comment structure. If you've ever been caught in a move that reversed violently, now you know why. Poor structure. The market's way of saying this isn't real. Yet. But identifying structure is only half the battle. The real transformation happens when you align yourself with the market's rhythm, when you stop fighting and start flowing, when you become one with the auction. Section 15, Becoming the Auction. The final evolution. Everything you've learned, every concept, every pattern leads here to the final shift, the hardest shift. When you stop trading the market and become the market, when separation dissolves, when fighting ends, when flow begins. This isn't mystical, it's practical. It's the difference between dancing with a partner and dancing as one, between swimming against current and becoming the current, between trading the auction and being the auction. And this shift, this is mastery. You can't force this shift, can't study it into existence. It happens when knowledge becomes knowing, when concepts become instinct, when thinking becomes feeling. One day you're analyzing the auction, next day you're part of it. Seamless, natural, profitable. The signs are subtle. You stop predicting, start knowing, stop hoping, start accepting, stop fighting, start flowing. The market doesn't surprise you anymore. Can't, because you're not separate from it. You're part of its rhythm, its breath, its life. This isn't about giving up edge. It's finding ultimate edge. When you become the auction, you feel shifts before they show. Sense imbalance before it appears. Know acceptance before it forms. Not through analysis, through alignment, through being. Paul Tudor Jones, October 1987, shorted the exact high. How? Not through prediction, through feel, through becoming the auction, sensing exhaustion, feeling rejection, knowing reversal before it happened. Because he wasn't trading the market, He was the market. The transformation starts with surrender. Stop imposing will. Start accepting what is. Stop needing to be right. Start needing to be accurate. Stop trading your opinion. Start trading market truth. This isn't weakness, it's strength. Ultimate strength. Every loss teaches this lesson. You fought the auction. Every win reinforces it. You flowed with the auction. The market rewards alignment, punishes resistance. Always, without exception. Learn this, accept this, become this. When you become the auction, fear dies. How can you fear yourself? Greed vanishes. How can you grab from yourself? Confusion ends. How can you misunderstand yourself? Trading becomes meditation, observation, pure presence. This state isn't permanent. You'll drift. Ego returns. Fighting resumes. Losses follow. But each time, return faster. Realign quicker. Because once felt, this state calls you back. Like home, like truth, like mastery. The practical path, daily practice. Before trading, sit quietly. Feel the market. Don't think about it. Feel it. Where's the energy, the tension, the flow? Let your body tell you. Your instinct guide you. Your alignment lead you. Then trade small, test the feeling, build trust in the market, in yourself, in the connection. Because becoming the auction isn't about size. It's about sync, about rhythm, about truth. Size comes later, after alignment solidifies. Jesse Livermore said it best. The market is never wrong. Opinions often are. When you become the auction, opinions vanish. Only market truth remains. And truth is profitable. Always. Forever. Without exception. This is the final evolution. From trader to reader. From reader to auctioneer. From auctioneer to auction itself. Each level deeper, clearer, more profitable. Until separation ends. Until you don't trade the market. You are the market. Type becoming if you're ready for this final shift. Because this isn't about learning more. It's about becoming more. Becoming the very thing you trade. And from that place of unity, everything becomes possible. Your journey starts now. One trade, one day, one transformation. You've traveled far. Through profiles and auctions. Through balance and imbalance. Through structure and flow. You've seen the market not as enemy, but as teacher. Not as chaos, but as conversation. Not as mystery, but as language. But knowledge without action is worthless. Theory without practice is pointless. Understanding without implementation is useless. So, here's your challenge, your call, your moment. Tomorrow, the market opens. Same charts, same prices, same opportunities. But you're different. You have new eyes, new understanding, new possibility. The question isn't what you've learned, it's what you'll do with it. Start simple. One day, one session, one perspective shift. Don't trade to win, trade to understand. Don't chase price. Read structure, don't predict movement. Interpret acceptance. One day of this, just one, and feel the difference. Watch the open, classify it, drive, test, rejection. Let the market tell you its mood. Then observe. Where's value building? Where's initiative controlling? Where's structure strong or poor? Not to trade, to see, to understand, to become. Then, if clarity comes, if structure speaks, if the auction reveals opportunity, take one trade. One. Based on understanding, not hope. Based on structure, not setup. Based on market truth, not personal opinion. Win or lose doesn't matter. Understanding does. Because this isn't about one trade. It's about transformation, from reactive to responsive, from confused to clear, from fighter to flow. And transformations don't happen in theory. They happen in practice, in real time, in real markets, with real money. The market has been speaking all along, every day, every hour, every tick, in a language older than charts, deeper than indicators, truer than predictions. The language of auction, of value, of human behavior made visible. Now you have the dictionary, the grammar, the comprehension. But fluency comes from immersion, from practice, from courage to see differently, trade differently, be different. So, tomorrow, when screens light up, when prices move, when others panic or chase or hope, remember, you're not a predictor anymore. You're an interpreter, not a gambler, an auctioneer. not separate from the market, part of it. One trade, one day, one new beginning. That's all it takes to start becoming who you're meant to be, a master of market language, a reader of auction truth, a trader who finally understands. The auction never stops speaking. The only question remaining is simple. Are you finally ready to listen? Comment ready. If tomorrow you'll approach the market with new eyes. If you'll stop predicting and start interpreting. If you'll begin the journey from trader to translator, because the market has been waiting for you to stop fighting, start flowing, stop guessing, start knowing, stop losing, start understanding. Your evolution begins tomorrow. Your transformation starts with one trade. Your mastery emerges from one simple shift. From noise to signal, from reaction to response, from confusion to clarity. The auction is calling. Time to answer.